Hi, Terry again. I'm looking forward to our upcoming meeting, but prior to that, I wanted to send you some additional information I think it's critical that you review before we get together. It'll help in our discussion. So what we're hoping to do in our meeting is to show you a better future than what you're currently on track to achieve. But first of all, I need to talk to you about the new normal. I've mentioned that in a couple of the other videos. What the new normal amounts to is something very fundamental has gone on in this country. In 2000, the national debt exceeded GDP, domestic growth production, by 200%. If you look throughout history, whenever that happens, you have fundamental changes go on within the society. Think about it for a minute. Back in the early 2000s, when we started having these abnormally low interest rates, you heard lots of people say, we're going to have inflation. This is going to create huge inflation, but it didn't. Why? Because the rules have changed. The rules changed because of the size of the government debt. The rules changed because of government involvement in the economy. If you'll recall, all of the banks and brokerage houses they bailed out in 2008. It's an interesting commentary. If you look back, there was a point in our history where everybody was worried about Japan buying the United States, but it never happened, did it? Why? Because the economy in Japan peaked. It peaked in 1989 and has never recovered. And at that time, our government told them not to bail out their banks, which they did. What did we do in 2008? We bailed out our banks. We didn't even follow our own advice. This is all part of the new normal. And to put it into perspective with these volatile markets, these low interest rates, if you'd invested $1,000 in the Nikkei, which is Japan's version of the S&P 500 in 1989 at the cap, and you'd accepted the buy and hold philosophy of Wall Street, 25 years later, your $1,000 would have gone down to $271. However, if you applied the principles of the better money method to that same economy over the same period of time, your money would have grown from $1,000 to $3,200. That's 1,100% more than the $271 you'd gotten if you stayed in the market. So that's why it's important to understand the new normal. The market of the 80s and 90s is gone. The demographic bubble that created it is gone. We're looking at a future that is much different than the past, and that's what I call the new normal. We are in completely uncharted waters. Everything the talking heads tell you hasn't been tested before. So one of the first things you need to realize before we have our meeting, you don't have what you think you have in your qualified accounts. And why is that? Because there's a lien on it. Remember I said people take short-term benefit of tax deduction at the expense of the long-term consequences? When you go into retirement, those consequences come home to roost because Uncle Sam has a lien on your qualified account. And this is one of the things I always have trouble convincing people. They look at that balance and they think it's theirs. No. You only get what Uncle Sam doesn't want. And he'll tell you what he wants when you're ready to take it out. So the 80s and 90s are gone, as I said before. One of the things you have to understand, throughout history, our economy has ups and downs. This chart is a little out of date because over here it says We've been in an up market for 61 months, now it's about 83 months. As I said, the government is manipulating the economy more. As the government manipulates the economy more, as the government prolongs these positive periods, the net result is when we have a correction, it's more severe than if the government hadn't prolonged it. And we've had all of these ups and downs since the 30s. But something you need to look at, the last two market corrections we've had, 2001 to 2008, are both the most severe market corrections we've had since the 1930s. And a lot of people that are smarter than me are projecting another drop of 40 or 50% in the foreseeable future. So numerous studies have come out. I told you before, the 4% rule is dead. Here's an example of a study done by some professors at a college. I can send you a copy of it if you want it. But the key is, what they said is that 4% rule is no longer valid, and if you want a high probability of your money lasting at least 30 years, you need to pull out 2.5%. That means if you have $1 million, you can have $2,000 a month in income. That's not much. But the big key is they were wrong if you look at the last 15 years. Here's what the stock market has done from 2000 through 2015. If you'd retired with $500,000 in 2000, you tried to pull out 4%, you adjusted it for inflation, what you find in the 10th year, you run out of money. And it doesn't make any difference whether you have $500,000, $1 million, or $1.5 million. You will still run out of money in the 10th year. So if you reduced that to just 2%, meaning on $500,000 you could get $10,000 a year, less than $1,000 a month, you're still down to almost nothing at the end of 15 years. And if you'll recall, I said baby boomers are the first generation in history to face the prospect of spending 25 or 30 years in retirement. And you don't want to run out of money. I define eternity as the period between the time you run out of money and you run out of breath. The better money method will outperform this drastically. As I've told you, a couple, age 65, one of them has a 50% chance of living to 92, a 25% chance of living to 97, and a 1 in 8 chance of living to 99. So here's the bottom line. You can continue to use the old school retirement system that you've been taught to use. With that, you will get higher taxes, lower rate of return, taxes on your Social Security. Or you can decide it's time to consider an alternative. With the better money method, you will not get higher taxes, you will get a better rate of return, your money will last significantly longer. As I've shown you before, 3 to 4 times as much money as being in the market itself. So please review this video once or twice if you need to before our next meeting. I'm really looking forward to meeting you. Thank you.